Welcome. How are you? Thank you for attending once again. This is Seewing Yee from Yee Real Estate Network, and my special guest on a weekly podcast is no other than Mr. Richard Advani from Supreme Lending, one of the nation's leading investment loan counselor that help real estate investors from all 56 to finance their investment properties to create wealth for themselves. So welcome once again to today's topic. We're going to talk about the real estate investing. We could talk about really some conclusive data, proof to people once and for all, what's the reality of the real estate, and not be emotional about it, and learn, go over the data and the metrics and the trends so you can make an informed decision. So I'm going to share my screen right now, and here we go. All right, full screen. All right. As we so here's the U.S. real estate market. Welcome, Richard. How are you?
Good. Thank you.
Yeah, thank you for your time. You're very busy doing loans each and every day. You're a busy man. All right. So the U.S. housing market is short 3.8 million homes, according to one source, just to meet the spring demand for 2022. But the big picture is, look, let's be real. Ever since the 2008 real estate crash and the recession, the construction industry, as you can see, they're lagging. I mean, they have, over the past 10 years or so, they have built so little homes. Now, so these 7 blue columns is a 10-year time frame of the number of new homes being constructed, on a 10-year increment. And then you look at the on the red color from 2010 to 2020 approximately, there were only like a fraction of new construction, which is a 5.8 million homes. So this shortage of supply of homes, it just did not happen just because of the pandemic. It's been a long issue that I've been noticing for the past 10 years, and Richard Advani, same way. But so is a tremendous lack of home construction in the past 10 years. And then when the pandemic hit a couple of years ago, it just exacerbated everything. So right now, as you can see, it's like you heard this before, right? So for those of you that watch YouTube channels, whatever medium platform you're educating yourself on, it's clear that we have a record low inventory, and still very strong demand. So it's really economics 101. When demand is greater than supply, housing prices will go up. All right. So quickly, let's go over this. Another source mentioned we are really 6.8 million housing shortage. This is totally mind-boggling. And another graph stating that once again, all the housing that are needed from based on the various time frame, as you see here. And then Forbes magazine a few months back, they say the housing shortage is worse than ever, and it will take a decade of record construction to fix it. Decade. We talking right now is 2022. We're talking about for the rest of this decade, from 2022 to 2030 approximately, right? So, and then as home buyers and real estate investors, as they scour each neighborhood to buy their properties, here's a typical, very poignant picture of a potential buyer to your left, husband and wife couple, whatever, and then the realtor to the right. And here's the comment, which is I find it very funny. We really like to look at something a little higher priced And a realtor say, okay, I can show you this house again tomorrow. And that says it all. All right, so here's what the current situation as we speak. This is a real-time information as we are moving into the second quarter of 2022, which is in April, which is time flies, isn't it? So it is estimated that we need right now 1.5 million homes that are for sale at any given time. And currently, by the way, there are only like, don't quote me exactly, there are only around a little bit less than 300,000 homes available for sale. So essentially, we are supplying only 20% of the supply of inventory available. That means in order to like 6 months supply of homes is what we call it equilibrium. That what we call it a balanced market, right? But I know every market is different, right? There are 400 MSA, metropolitan statistical areas in the US. So every local market is very different, but I'm using one example. This is the February statistics in the city of Austin and Austin Round Rock. And you can, I just want to quickly mention at the lower right-hand corner, as we speak, there are 0.3 months supply of inventory. You know what that means? That means 0.3, there are like 3 weeks supply of inventory. If there are no new inventory comes into a marketplace, in 3 weeks from now, there will be no houses for sale in the city of Austin. The city of Austin, I don't know the exact population, maybe like 500,000. Again, don't quote me, I don't know, but 500,000 people in this metro, in this county city of Austin. If you look on your left, there are like 887 homes available for sale. This is mind-boggling, right? And then same thing on the right-hand side, Austin, Round Rock, and another county, same thing, 0.04 percent weaker inventory. It's a record low inventory. If you look at 2021 year over year, February 2021, when in Austin, they were like typically like 100 offers per house. I mean, it's at that time. And at that time, there were more inventory last year, same time, as opposed to right now. So right now, I say it again, is the record low inventory that, I mean, that this data was, was extracted like back in the 1960s, like 50, 60 years ago, when these data are typically available. So this is mind-boggling. So again, in order to have a balanced market, we need to have 500% more supply of inventory to make it a normal market. So I'm not gonna, and here it is, right? This is mind-boggling. So we are way, long way from doing, to having enough supply. So think about it, Richard, you know it firsthand. You are a investment loan agent. Like last year and the year before during the pandemic, the interest rate were like mid-twos, like 2.6% on a 30-year fixed rate amortized mortgage. This is record low. And most people that have purchased their home or refinanced at that low rate, they locked it in for 30 years. If any of those homeowners that currently have a low rate below 3%, good for them. They took action through Richard and other loan agents over the country to lock in the record low interest rate. Now think about it. Now, what if some of those homeowners, they want to sell to upgrade, right? Move up or even move down. So why would they want to sell a home that's locked in at a 2.6% interest rate and then go out to the open market right now when there are acute historic record low inventory and go through the bidding war, multiple offer situation to buy another house if they can find one that are potentially probably higher price than a year or 2 years ago, and then potentially pay a interest rate like 4.5 or even 5%. We're talking about huge amount of additional monthly mortgage payment. So, most people would be crazy to do that. So as a result, a lot of those people, Richard, you can chime in on it, they're not selling their homes. So it just, and then finally the builders, you and I, the new builders is taking forever to build the new construction of homes due to, we've been hearing that massive labor shortage in construction workers, supply chain disruptions and skyrocketing construction costs. And it took a very long time to get the permit, to get the foundation, to get the licenses for the builders and for the developers to start constructing. And the timeline for building a homes from pouring the foundation until the completion of the house could very well take more than a year. In some instances, a year and a half to complete construction of a home. So new construction is lagging, and then current sellers are most likely not selling. So it'll continue. I predict this imbalance of supply and demand. I know Richard, you can chime in now. I mean, right now is the interest rate, I believe, for the rest of this year could hover, bless you, between mid fours or high fours, and the demand could slow a little bit because some buyers are priced out of the market because of their higher interest rate and the higher mortgage, and the demand will be probably less. Instead of 10, 15 offers per house, perhaps there will be 3 or 5 offers per house, right? So still a seller's market, still I don't see any big time correction or definitely not a crash, right? Economics 101, right? Low supply, high demand still. And then one more thing, the people that owns a house, either recently or over the years, I mean, the amount of equity that are people are holding in housing is just mind-boggling. 3.2 trillion worth of equity. So we congratulate the primary home buyers. We congratulate real estate investors that bought rental homes. Your wealth have increased, quite nicely, especially in the past 2 years. So, all right. So that's all I have to say. So sorry to make you wait so long, Richard. So just provide your 2 cents in about 5 minutes or less, and we'll conclude with this presentation. So from the big picture, what are your thoughts of what I just said?
Yeah, I mean, obviously we all know there's a housing shortage, nationally, like you said, but seeing those figures is definitely refreshing and reassuring. As you know, obviously I have, over a couple dozen rentals across the country. And like you said, basic economics is supply and demand. So, if there's going to be limited supply for the next decade, then, we can hopefully infer that the real estate market's going to be pretty strong through. Now, look, if there's a recession globally, nationally, obviously everything's going to get affected to a degree, but, I don't think we're going to see in that recession real estate crashing like it did, in 2007, 2008, where stuff dropped to half its value. There's still so much demand versus supply, even in that scenario, like you said, just how things work. Real estate should be still good for the long haul. Now, the question is whether you can actually find inventory, and, it's tough. And, normally you're signing contracts into the next year sometimes, which is crazy, which makes it tough for 1031 exchanges as well. But, working with a group like Seewings, and working with the lender like myself, we handle 1031 transactions all the time. And, we have access to inventory that's not available to the open market. So, I still think I'm still obviously pro real estate. I've got a couple closings in the next few months myself. A lot of people ask me, if I'm still buying given the market where it is. And absolutely, yes. Inflation is rampant as well, and there's no better hedge against inflation than a 30-year fixed mortgage. And, I know a lot of people have a lot of money in stocks right now, and stocks are the highest they've ever been. With that same logic that people use to say, hey, real estate's high, I mean, sell some stocks, diversify, right? Put that money to work to actually generate an income. Because right now stocks aren't generating an income till you sell them. Then you got to pay Uncle Sam. Whereas with real estate, you'll generate an income from the rent. You will be able to depreciate it. So now it's tax-free income. And the property is going to appreciate as well. So if you don't have real estate in your portfolio, which is most of the country, people have millions of dollars in their securities portfolios and bonds, but nothing besides their primary home. And, that's not a balanced portfolio. Your financial advisor will tell you, balance your portfolio with different stocks, because that's how they make money, right? They don't make money when you go buy real estate. So just keep that in mind. But yeah, it's like I said, it was very nice to see all those stats and figures and put a number on what the housing shortage actually means, right? It means we need to build, almost double the homes we built in the last decade in the next 8 years. So good news for all of us.
Yeah, I need to do a recap. My recap is this. Now, for owner-occupied buyers, yes, with a higher interest rate, 5% or whatever, there will be little bit less demand for owner-occupied buyers to buy their primary homes wherever they are. In Bay Area, median price is $2 million. Yes, $2 million in some areas in San Francisco Bay Area where I live. Similar with you, Richard. You live in Southern California. There will be a slight slowdown in demand, but primary home buyers will adjust. They just instead of home buyer right now, a primary home buyer, instead of buying a $800,000 home, that increasing interest rate, they can only qualify for a loan of maybe $700,000, right? So they have to go back to the drawing board and buy entry-level homes or cheaper. So I don't see they're gonna exit. I don't see the demand of buyers will slow down that drastically. It's just that they have to make some adjustments and buy low price homes based on higher interest rate. That's all. No big deal. As for risk investors that you and I work with, right? This is our business with investors. You may be paying 5%, 5.35, even 5.5%. I've done the calculations. As long as you buy entry-level investment homes, rental homes, like I've been coaching and guiding my investors, similar with you, Richard, when you do loans for buyers, same thing. I mean, as long as the homes are anywhere from $50,000 to $375,000, if you can get the rent, $375K, if you can get a rent for $2,400 monthly, yes, you can still cash flow at 25% down payment on even interest rate of 5.5%. So for investors, for real estate investors, this slightly systematic rising of the interest rate should not be a red flag. So you have to, we're different. Investors, you look at the cash flow, you look at the rent to value ratio, you look at the cap rate. So this will go on as usual for real estate investors. For primary home buyers, that's a little bit challenging for some people, but I don't foresee a crash. I don't even foresee a correction, just some minor blip. But anyway, that's all I have to say. Thank you so much. This is Seewing Yee from the Real Estate Network and my special guest, Richard Advani from Supreme Lending. Thank you for attending. Have a nice day.